All right. Hello, everybody. Thank you for joining us here today for our weekly options recap session. My name is Mike Rixey. I am the lead options instructor here at NetPicks. And the goal of today's session, I want to recap some of the trades that we have taken on our side here this week, walk you through why we took those trades, how we manage them. And then I also want to take a look at some of the new trades that we're looking at going into next week. It certainly has been a very active stretch for the market. We have seen some pretty big moves, pretty big swings back and forth. So I want to walk you through what we're expecting going into this fall. We're expecting very active conditions. We're going into an election cycle. We're already in it, but it's really going to heat up over the next number of weeks. And then we also have all the uncertainty with COVID. Now going into fall, everybody's going back inside, going back to school. Some people are going back to work. We'll see how that impacts things. All that to say, I think it's going to be a very active stretch for traders. I think we're going to have volatility to work with. I think we're going to have wide ranges. I would be very, very surprised if we got into a one-way market again, either to the upside or to the downside. I think we're going to have back and forth movement. I'll walk you through some of the technicals that we're looking at going into the next few weeks. So if you have any questions at any point during the session here today, let me know. Feel free to just type in a comment into the comment section, and we will get to those as soon as we can. So just make sure that everybody's able to get in okay. All right. So what you're looking at here is the daily chart of SPY. This is the S&P 500 ETF. I don't trade off of this daily chart, not looking for entry and exit points off of this chart. What I use it for is to gauge overall market sentiment. It helps me determine how aggressive I am with my trading, whether I'm going to use weekly or monthly options. Am I going to use long calls, long puts, or am I going to use more debit and credit spreads? I want to base my decisions off of technicals and price action, not based off of what I'm hearing on CNBC or Bloomberg, Fox Business. Well, when you take a look at this chart, the indicators here on the chart, nothing complex. All it is just a set of simple and exponential moving averages. Just looking for key areas of support and resistance. Down at the bottom, I have a moving average. Moving average of the volume. So it takes a look at the daily volume, and then it plots a moving average through that histogram. Below that, we have an ATR, the average true range indicator, just indicating the overall range in the market. And that can help as well determine what types of strategies that I'm using. If we're in a very active market, we're seeing a lot of wide ranges, we can get away with using more of the aggressive approach, the long calls, long puts, the weekly options. If we don't have good range, we saw a stretch back in July where it was just kind of that slow, steady grind to the upside. We saw very little back and forth movement. If you get into a slower environment, I typically shy away from using the weeklies and lean more towards the monthly options, just giving myself more time to be right. All about taking what the market's giving us. Well, looking at this daily chart of SPY, if I zoom in a little bit, you can see that we are testing a very key support level right now here this week. Those yellow lines on my chart, those are the 50-period simple and the 50-period exponential moving averages. Very widely used in the market with a lot of traders looking at these levels. And if I zoom back out, you can see anytime that we have tested this level, really going back into April, anytime that we have tested this level, it is held as support, and we've actually had a decent bounce off of this level. That's why where we close today, and then specifically early next week, where we react around this level is going to be crucial. If this level breaks on the downside, we could see another wave quickly to the downside. If it holds and we get a bounce higher, we could certainly get a move right back up to the upper end of the range that we've been in over the last number of weeks, which is up around the 342.39 level. This level right here, you can see, has acted as resistance the last few weeks. Anytime that we've gotten up to the top portion of that range, we have seen a nice reversal back to the downside. So right now, where we're sitting at currently intraday is very, very important. And let me get you the exact levels that we're looking at there. We've got these levels in between 333.90 down to 332.86. That's an area of support that we're watching very, very closely this afternoon. It happens to be expiration today as well. Expiration day, it's very unusual to get big sell-offs on a monthly expiration day. I'm not saying it's impossible. We're seeing selling today, for example. Historically speaking, you don't typically see these big moves lower going into expiration. So we'll see what happens this afternoon if we do get a bounce off of these lows, if the market decides to hold this support level, or are we going to break through it and get another wave to the downside? So the next couple of hours, very, very important. Also important to point out that on any type of move to the downside, we have gotten a burst of volume. When we get these moves higher, the volume tends to contract, and it's been a struggle on the upside to hit 50, 60 million shares. When you start to get these moves to the downside, I mean, we're well above 80 million shares on a regular basis. So the volume is certainly there on the downside. It's not there on the upside. Just important to point that out. If this market is going to break higher into the end of the year, we need the volume to confirm the move. We want to see some volume come back into this market. So what I am expecting here this afternoon, I would expect this market to, at least over the next couple of hours, try to defend this level, this 50 moving average. If we can get a move off of that low, that sets up nicely for a bounce going into next week. If we close down near the lows of the session, that could lead to another wave to the downside going into next week. Now, here's part of my concern. If you're looking for a move to the downside, here's one of the issues. This is the VIX. This is volatility. Normally, when you get market sell-offs, volatility expands. Right? You start to see fear come into the market, and it's priced into the options. Here today, we're actually seeing the VIX lower on the session. Okay, you've got the VIX down over $1. Very, very unusual to see the S&P down 17, the NASDAQ down 100, and the VIX lower as well. The VIX is not buying this selling. If we are going to get this washout move where we break support and everything just falls apart, we would see volatility contract. We'd see volatility expand. We're seeing it contract at the moment, and that's concerning if you're looking for a break lower. So volatility, at least intraday here, the volatility leads me to believe that this support level is going to be held, and at least in the near term, we're going to bounce. Whether it's sustainable or not, time will tell. But volatility is certainly not buying into any of this weakness in equities so far today. If we take a look at the internals, and I'll get to some of the individual charts here in just a second, guys, just trying to do the broad overview here first. All right, if we take a look at the internals, what I'm looking at here in the upper left-hand corner, we have our volume ratio. It takes a look at the up volume versus the down volume in the NYSE, or the New York Stock Exchange, and then the NASDAQ. What I want to see here, if this was a truly just a washout move lower, we'd see volume at -3 to 1, -4 to 1. And right now, we're barely at -1.2 to 1 and 1.3 to 1 on the NASDAQ. So the volume is not showing that panic type move. This is very indicative of a choppy market. The advanced decline line in the upper right-hand portion of the screen, it just shows us simply in the NASDAQ how many stocks are moving higher versus how many stocks are moving lower on the session. Right now, the advanced decline line is actually sitting at +169. There's actually more names moving to the upside than the downside today in the NASDAQ. So what gives? Why is the NASDAQ lower? Because the key names, Apple, Amazon, Facebook, Google, a lot of the key tech names have been weak. Facebook actually has turned positive here today, but a lot of the other tech names, specifically Apple and Microsoft, they're lower. Those big components of the NASDAQ are lower, and that's why we're weak. If those names bounce, again, with the volatility, not buying into the weakness, we'll see if that leads to a bounce off of the lows. The tick in the lower left-hand corner shows us at this very moment in time how many stocks are trading on an uptick versus how many stocks are trading on a downtick. What I'm looking for is extremes. I'm looking for either moves above +1,000, that upper red line, that would indicate a buy program kicking in, or a move below -1,000, that would indicate a sell program kicking in. And what I want to see ideally is clusters of extremes, and we're not getting that today. In fact, we have only had one extreme today. We had one level there right around 1130 where we approached a -1,000 tick reading. The rest of the day has been pretty muted. We haven't seen any type of panic type move yet. And over on the 5-minute chart of SPY, you can see the noise. I mean, yes, we have drifted to the downside, certainly, but we're not getting those washout moves where it's completely one directional. That's why it's so misleading. If you come in and just take a look at, the overall index numbers, it doesn't give you a good glimpse of what's truly going on. Yes, the market is lower right now and price action's king, but when you dive in under the hood a little bit, you can see that it's more mixed than anything. That's why it wouldn't surprise me at all if we get a bounce to the upside here going into the close. We're not getting those panic type levels yet on some of these internals that we track. So this is what I look at all the time, because I can't look at the markets all day long from opening to closing bell. These are the tools that I use all the time to come in and quickly get a snapshot as to how strong or weak the market is. If you never use the internals, you're going to be just fine. If you're somebody that's day trading actively throughout the day, that you're going to have a better feel for the market just in general. I don't have the ability to do that. I'm working with customers all day long. So I have to have a quick way to come in and get a feel for what the overall market is doing. So definitely going to be an interesting afternoon going into expiration at the end of the day. Let's talk through some of the trades that we have closed out here this week. And let me bring up my spreadsheet. So going into this week, we actually had a put spread that we had on Netflix, specifically the 485, 475 put spread that we bought for $4.70. Normally, when I buy an option, if I buy a call or a put, or if I buy a debit spread, I am typically targeting 100% return initially. I'm looking to double my money. That's in a perfect world, right? That doesn't always happen. And the reason why we had to close this trade out earlier in the week, and we sold it out for a $6 credit there, and we booked $130 profit. It was only a 28% return. I had questions come in from people saying, why did you close out of that position? You didn't hit your 100% target. The problem here is that Netflix, excuse me, those options were in the September 18 options expiring today. When you get into expiration week, it's very, very difficult to hold all the way to expiration because the time decay is so extreme. If you hold too long, that trade can go from a small profit to a full loss very, very quickly. So when I start to get this close to expiration, I still liked the trade. I still wanted to see, Netflix move lower because the overall market has been weak. I had to close it out, book the partial profit because I wasn't willing to run up against that extreme time decay of expiration week. So it was still a nice winner, 28% return. We'll definitely take it, especially if I go over to the chart here. Let's switch back to the daily chart. And we'll switch this to Netflix. Yes, we did get a move to the downside. We actually got into this trade before this move to the downside kicked in. We actually got into this trade right here before this extreme bounce to the upside. This big, large green candle. We actually got in shortly before that green bar. So we were dead wrong for the first week of this trade. Fortunately for us, it did reverse back to the downside, and we were able to book that partial profit. So again, I'm not going to force every trade to hit on 100% return. I'd love to see as many as possible, but sometimes taking that partial profit is the smart thing to do. In this case, we had to do it because of expiration. The next one up on our list was Costco. It just happened to be another $130 winner, but this one was a 41% return, and this one was a credit spread. We sold the spread to open the position. I'm going to drag the spreadsheet off to my other screen here so I can show you the charts of Costco here. So let me pop this up. So what you're looking at here on the screen is a 195-minute charts of Costco. So you get 2 candles a day instead of 1. The indicators that you're looking at on the chart, we've got a couple of moving averages up top. We've got our 8-period exponential moving average, which is the red and blue line there. And then we've got our 50-period exponential moving average, which is the yellow and white line. Down below, we have our pulse indicator, which is the red and yellow histogram. I'll come back to that in just a moment. And then we have our trend strength indicator, which is the blue and the red histogram down at the bottom. The trade on Costco was driven by our pulse indicator. And notice we got a whole cluster of yellow bars here. This was a couple of weeks ago. When I start to get yellow bars, in this case on the upside, what that tells me is price action has hit an overbought extreme. Specifically, we're between a 1 and a 2 standard deviation channel move on the upside. When you start to see that level hit, it'll typically lead to either a sideways stretch, a sideways period of consolidation, or a reversal in the other direction. Right now, fortunately for us, as soon as those yellow bars printed here, ideally, I'd like to see 3 out of 5 bars plot yellow. We actually had that. We had 5 bars in a row that plotted yellow. And look what happened. As soon as those bars started plotting yellow, look what price did. We hit an extreme on the upside, and we almost immediately reversed lower. Has it been the cleanest pattern to the downside? No. It's been more of a drift to the downside with some back and forth movement during that stretch. But when I start to see an overbought condition like this, I want to sell a call spread. If I buy a long put looking for the market to reverse, I only have one way of making money. That stock has to move lower immediately. With Costco here, I sold a call spread, which gave me a more forgiving trade. Selling a call spread is still a bearish position. I still want the stock to move lower, but I have more ways of making money. If we do just move sideways instead, I can still make money. So here is what we did on Costco. Drag my spreadsheet back over here. We sold the 345, 350 call spread. In other words, I'm selling the 345 call and I'm buying the 350 call at the same time. And we collected $1.80 or $180 per spread to put the position on. Now, a lot of times people get intimidated by selling options because they think it's a lot of risk. In this case here, it's a fully risk-defined trade. The most I can lose is $320 per spread. If I am dead wrong and Costco continues to move to the upside, the most I can lose is $320. Right? So in this case, I make money if Costco moves up, down, or sideways, as long as it stayed below 345. I also made money from time decay adding up. Every day that passes, that helps me. And I made money from volatility decreasing. Those are the 5 ways that I had of making money on the position. Fortunately, as I showed on that chart, we did get a move lower. We did get the time decay to add up, and we were able to buy the spread back for 50 cents. That gave me my $130 profit or a 41% return on my capital. Had some questions on this one as well. Why did I close out of this trade early? Why not just hold the expiration and book the entire profit? There was still 50 cents or $50 per spread of profit potential that I could have booked had I held another couple of days. The problem is, when you get into expiration week, the gamma risk also increases, which means the options become very sensitive to changes in stock price. What I don't want to do is get into expiration week, have a trade go from a nice profitable position to an immediate loss if I hold too long. Had I held and Costco bounced to the upside here going into the end of the week, this thing would have gone from a partial profit to an immediate loss. What I like to do is I like to close out of my credit spreads, book my partial profit, free up the capital, and move on to the next trade. That way I don't have to mess with expiration. And with commission charges so cheap these days with a lot of brokers, there's really no reason to hold the expiration. If you use Tastyworks, for example, which is my desired broker, they don't charge a closing commission. So you might as well just close out of the trade. You don't have to pay a commission to do it. Close it out, book the partial profit, and move on to the next trade. And that's exactly what we did there on Costco. The final trade is a trade that we just put on here yesterday afternoon, and we closed it out here yet this morning. I want to walk through this trade because it's a really nice trade. It's one of those unique situations. We're going into expiration. We already talked about the expiration is this afternoon. And we also talked over on that daily chart of SPY. We had talked about how we're testing the 50-period moving averages, right? So as of yesterday afternoon, we were sitting right on top of those moving averages. So I was expecting the market to hold as support, that level. And then I was also looking at expiration, knowing historically that monthly expiration, you don't typically see a lot of large sell-offs. It just doesn't happen all that often. So what we decided to do for an overnight trade is we decided to come in and sell a put spread. Selling a put spread is actually a bullish position. We want that stock to move lower. We utilized, let me go over to the trade page and let's go to SPY here. We utilized the options that are expiring this afternoon. And we came in and we sold the 32.30 put spread. So I sold the 32 put And then I bought the 30 put at the same time to put on a risk-defined trade. All right, let me go ahead and get this trade queued up here. We sold the spread initially for 60 cents. We collected $60 per spread to put the trade on. It required $140 of capital to put the trade on. So it was a very low risk trade if you wanted it to be. Yes, you can trade multiple contracts. You can trade multiple spreads because it's the most liquid product in the world. SPY has a ton of volume and open interest. So we actually closed this trade out. First thing this morning, after the market opened, we did get a small bounce. It only lasted about 15 minutes or so, but it was enough to close out of this spread. We bought it back for 20 cents. It gave me a $40 profit. That was a 29% return on our capital. Now, here's the key point here. Did we get a big move higher? We can clearly look at the market right now, and it's still lower. The S&P is actually down. The futures are down 29 points. SPY is down $2.40. Did we get the big bounce higher? We didn't, but we were still able to book a 29% return. The credit spreads are so powerful. It's not the perfect strategy, but it's such a powerful approach because it takes a lot of the pressure off needing those big directional moves. I didn't need a huge home run directional move to the upside to make money on this trade. We got a flat open. We saw a small bounce for about 15 to 20 minutes here this morning, and we were able to close out of this trade immediately and book the profit. This is a trade that I will use a lot of times in front of expiration. It could be a monthly expiration. It could be one of the midweek expirations that SPY has as well. You can use those overnight trades. Just make sure that you're keeping your risk small. It's not a trade that you want to load the boat and say, hey, I'm going to take a huge position. But if you keep that risk small, these are very high probability trades going into expiration. I use these trades quite a bit in my own trading, especially around the monthly expiration. You have to do it in a liquid product. You've got to use SPY, or you can use Apple or Facebook. Just make sure you're using a liquid product so you can get in and out quickly. But it's a really reliable trade that I've used quite a bit over the years. So that was a trade that we did with our NASDAQ Superstars students here yesterday afternoon, and we just closed it out here this morning. All right. Now let's take a look. Let's transition back on over, and let's take a look at some of the markets that I am keeping an eye on for next week. Let's talk about, let's just go over to a chart of SPY. We'll start there. So notice on SPY, we're back to the 195-minute chart here, and we've got our trend strength indicator down at the bottom. It's the blue and the red histogram down there. And it did roll over here back a couple weeks ago, actually. We saw it flip back below the zero line, indicating that bearish momentum is taking over. That typically has me looking for a potential long put opportunity. We also got price action to finally get below the moving averages here. And we did end up taking a long put position. We're currently in a long put. Let me get my data window up there. All right, so our entry point on the downside was at 346.18. I'm sorry, that was my stop. My entry point was at 337.68. Got to look at the right number in my data window there. So is this little blue crosser? That was our short entry point. We've just been hovering right around that entry point for the last week and a half or so. Finally starting to see a break lower. So what am I targeting on this type of a position? When I buy a long put, or it could be a long put spread for that matter, anytime that I'm buying an option or a spread, I'm targeting 100% return. That's what I'm looking at here. I'm still looking for a break lower going into next week. Again, I talked earlier, wouldn't be surprised if we get a bounce this afternoon or even early next week. But big picture here, I am looking for the next wave to the downside. Ideally, that would help our long put position here on SPY. My stop is currently up at 346.18. This level of pink dots up at the top. If I am wrong, we get that bounce to the upside, big picture, we continue to make a run towards the highs, that's my stop point. I would take the position off at that level. I am trading more monthly options at this point, especially with any type of a long option. I like to go out between 20 and 40 days. That's the typical window that I'm looking at. I have been trading a lot of the October monthly options that have 28 days left to expiration. That's my go-to right now. As we get into next week, let's just say we get into next week and we don't get any type of big movement. Let's say the market just settles into a range. We start to chop sideways. I would, at that point, start to transition any new positions. I'm going to start to look out further in time, and I'd start to look at November at that point. The November options have 63 days left, a little bit farther out than I normally like to go. So I'm still trading October through this week, obviously, with the markets wrapping up the week. But then next week, if we get the market to continue to stay active, if we see volatility elevated, we start to see these moves back and forth continue, I would continue to trade the October options through next week if we stay in an active environment. Could you go out? I get this question a lot. If you're in between cycles, we're saying, hey, I don't know if I should use the October or the November options here. Why not just use the weeklies? I'm okay using those weekly cycles. Just make sure that you have good liquidity. Not all products that offer weekly options offer liquid weekly options. In a lot of cases, those weeklies are more difficult to trade. They don't have as good of liquidity. So just keep that in mind. Not opposed to it. Especially on names like SPY or Apple, you can get away with it. Just be cautious. Just make sure that there's enough liquidity there. Arjun stating, I've just recently found your channel. Like your videos. Great job, mate. Greetings from India. I appreciate that. Thank you for the feedback. Glad you're finding it beneficial. And feel free to contact us with any questions or comments you might have. Love to hear it. All right, so at this point, would I initiate a new trade on SPY? If you're just coming in saying, okay, I'm not in that position that you talked about, Mike, would it be okay to grab the position now? I would not, because we're already below the entry point. It's already in a small profit. I would hold off. If you're already in a bearish position, that's fine on SPY. I'd continue to hold. I just wouldn't be looking to initiate this trade at this point here today. Apple. Let me load up the chart here. We've got a lot of programs running on my computer, so it's running a little bit slow. Hopefully it'll speed up there. All right, so on Apple, very similar story to SPY. Our trend strength indicator did flip below the zero line. We did go from blue to red. We did get price action moving down below our moving averages. We did trigger short, and this one has been in the short trade. Okay, you can see my little blue cross right there. That was my entry point, and we came in. You could have bought long puts. You could have bought a long put spread, just depending on how much risk you wanted to take. I am personally in the long puts. This one is moving nicely. Okay, we're into profit. We haven't hit our target yet. Again, I'm buying a put option here, so I'm targeting a 100% return. Hasn't hit that yet. It's making a nice move to the downside, so I'd love to see it. Now we just need a little bit of follow through going into next week. But here's where it's important to notice what the stop is doing. The stop was initially up at our full level, the upper level of pink dots there. Now that we're starting to move into profit, notice how the stop is also starting to move down. The pink dots are starting to move down, meaning we're starting to reduce the risk. We haven't taken all the risk off the table yet. We still have some risk there. If this thing does flip around on us and move higher next week, we still have risk there. The goal is to get to a break-even stop as quickly as possible. If we get a move lower this afternoon or early next week, we should be able to get that stop really ramping down towards that entry point. So again, just like SPY, if you're not in the trade already, if you're not in a bearish position on Apple, now is not the time to initiate a new trade. You'd want to hold off at this point because it's already in a profitable position. If you're initiating a new bearish position today on Apple, you're chasing. You're getting in late, and the odds just decrease from there. So I'd rather have you hold off and wait to see what happens next week. Let's talk about Caterpillar next. Let's talk about CAT. As long as I can get my platform to respond here. So on Caterpillar, there's been a few pockets of strength. That's been the interesting part about this market. And while TradeStation is still trying to pull up the chart for me, let's go back and let's take a look. If you take a look at this overall market, I like to track the futures. And the futures are over on the left-hand side. My watch list on the left-hand side, all of those symbols that have the / in front of them, those are the futures markets. And if you take a look at / NQ, that's the NASDAQ. Right now, we're down 170 points on the futures. The Russell, on the other hand, / RTY, is only down 6 points. The Russell was actually positive earlier in the session. We have had this tug of war going on between the index products. There's always one strong area. The NASDAQ has been super strong the last number of months, but here lately it started to give it up a little bit. And now the Russell has tried to take the baton. The Russell's been trying to kick in, but you had a lot of divergence there. You had a lot of inverse correlation where you had the NASDAQ moving higher for a while. The Russell was lagging behind, and now they've completely flip-flopped. Now we've got the Russell actually doing its best to hang in there and the NASDAQ getting hit again. The reason I bring this up, we continue to see a lot of sector rotation. We don't get those broad-based market moves. That's been the missing piece. And that's why this market, that's why every dip has been bought. There's always that one area of strength that prevents some significant damage from being done. The only time that we really have seen a broad-based market move is back in March when COVID started to really take off here in the US. We saw that broad-based move where everything got hit. But even on the wave to the upside from April into just the last couple of weeks, there's always been one area that's been lagging behind. There's always that sector rotation. So that's why it's so crucial to stay diversified. And I bring that up because you take a look at Caterpillar, you've got the overall market getting hits today, finally. But you actually have Caterpillar. You have names like Caterpillar up $1. You've got some of the financials like Bank of America up 13 cents. So there's some little pockets of strength in here that we have identified. The reason I point that out is going into next week, let's just say the tech sector decides to bounce. If that happens, guess what might happen to these names that are positive? Names like Caterpillar and Bank of America. We could see that rotation again out of Caterpillar, out of Bank of America, and into the tech names. Okay, you've always got to think about that rotation because it's been there now for months. Let me see if I've got the Caterpillar chart up. And unfortunately, TradeStation's not going to cooperate. So what I'm looking at on Caterpillar, if I were to go over to the chart, which is not loading up, I apologize for that. Unfortunately, TradeStation's locked up for me. But what it's going to show is that Caterpillar is between a 1 and a 2 standard deviation channel move on the upside. We have the yellow bars on our pulse indicator that are plotting. Right? We talked about those over on Costco. Right? And we talked about selling a call spread because what happened on Costco? As soon as those yellow bars started printing, we saw a reversal in the other direction, right? Caterpillar is in a very similar situation now where we've got a whole slew of yellow bars plotting. Caterpillar's had a nice move to the upside and it's overbought in the near term. What I would be interested in at this point is potentially selling a call spread on Caterpillar. So I'm going to use those October options, the ones that we talked about here a few moments ago, the ones with 28 days left to expiration. And I'm going to go out, switch this from SPY to Caterpillar. I'm going to go out to the out of the money call options, and I want to put on a trade that would benefit from either a sideways move on Caterpillar or a move to the downside, because those are the patterns that typically develop when we get these overbought conditions. So let's go to the 160 calls. Okay, I'm going to right click on the 160 calls, go to sell, and I'm going to select a vertical. And in doing so, that's going to pop up an order down at the bottom where I would be selling the 160 call and buying the 165 call at the same time. It's a $5 wide call spread. Right now it's trading for around $1.41. If I get filled at $1.41, I would be collecting $141 per spread. My risk on the trade would be $359. That's the most I can lose on the trade. So right now we're in between risk 2 and 3 to make 1. Why does that make sense? That goes against what a lot of people teach, right? With a credit spread, you're always going to be risking more to make less. And the reason we're okay with that is we have 5 ways of making money on this position. It's going to have a higher probability of success long-term, right? So let's talk through those 5 ways of making money. Let's talk about the directional aspect first. If I'm selling the 160 call, I want price action to stay below 160. I don't care if Caterpillar moves up, down, or sideways. As long as it stays below 160, we're okay. We make money. And actually, we're going to take that a step further because I'm collecting $1.41 to put this trade on. We add that on to my short strike, the 160 strike. Now I just need Caterpillar to stay below 160, 141. Price action right now is at 154.85. Remember, we're overbought. I'm expecting either a sideways move or a move to the downside on Caterpillar over the next few weeks. I can be dead wrong on this trade by almost $6 and I can still make money. The only move that hurts me is a move above 161.41, which we're not expecting because the market's already overdone. So up, down, or sideways, all three directional moves were okay. We also make money if volatility decreases and if time decay adds up. Those are the 5 routes, any combination of those 5, and we get to make money on the position. It's also a lower risk trade. I mean, you're tying up $359 of capital. If you've got a bigger account size, sure, you can bump up your position size accordingly. I have no problem with that. But not tying up a ton of capital to put on a credit spread here. And we'll just wait and see what happens. This is not going to be one of those overnight trades. This is not going to be a trade that come Monday morning, we're already getting out of it. We're going to have to hold here. A very typical holding time for us is anywhere from 3 to 30 days. With 28 days left to expiration, we're probably going to have to hold. Between 7 and 15 days would probably be a typical holding period for us on this trade, depending on what Caterpillar does. We make money the fastest if Caterpillar moves lower. So if that happens next week, that'd be great. We're going to go into profit quicker. If we don't get a move lower, if we just kind of chop sideways and consolidate, we're going to have to hold longer and wait for the time decay to add up. That's where our holding time would extend out towards those 15 to potentially 20 days. All right. So that is Caterpillar. And let me try to close out some programs here. Let's see if I can get TradeStation to unlock for me and not be frozen. And it's still not responsive. I might be having an issue there with the TradeStation platform. So the next trade I want to take a look at is Bank of America. We talked about Bank of America being one of those names that is actually held in there, right? I mean, it's up 12 cents. So the rest of the market getting beat up here, Bank of America is actually hanging in there, right? So it's up 12 to 13 cents. But again, what I'm thinking about here, our trend strength indicator, I wish I could show it to you right now, but I can't because TradeStation's not responding for me. But the trend strength indicator has actually flipped below the 0 line. Even though it's up 12 cents today, bearish momentum has actually started to take over on Bank of America. So what we're going to look at here is just a straight long put. The key for us is getting diversification, not only in the markets that we trade. Yes, you can mix it up with individual stocks and ETFs. That's important, but also mixing up your option strategies as well. Using some weekly and some monthly options, using some long calls, long puts, and some vertical spreads. That is the key. And that's missing for so many people because they get so locked into trading Apple and Facebook and QQQ and all very correlated tech names. And I understand those are great products, but you want to get better diversification. If you just take that approach and lock yourself into one small group of tech stocks and only trading those products with long calls, long puts, it's going to be more difficult to see consistency over time. You start to mix in markets like Caterpillar and Bank of America and some energy names, some ETFs, and you also mix in some vertical spreads. That's when you start to see more consistent returns over time. So we talked about some credit spreads already here today. Let's talk about mixing it up, and let's talk about just buying a long put on Bank of America. Let's stick with the October options. I mentioned I'm going to continue to trade these options at least through this week and potentially through next week as well. So let's go over to the long puts over on the right-hand side. And let's go ahead and take a look with price action right at 25.50. I'm going to take a look at the 27 puts. Now, why? Why am I going to the 27 puts? Ideally, I like to trade, in most cases, I like to trade options that are 1 to 2 strikes in the money. I'm not opposed to trading options that are either at the money or slightly out of the money. But if you're going to do that, it's a very aggressive trade. You have to have a very strong directional opinion on that stock or ETF. Bank of America here, I'm looking to be a little bit more conservative. This market has been all over the map here lately. Anytime this market has looked like it's going to completely break down, all of a sudden out of the blue, we get these headlines to hit. There's a breakthrough with some of the treatments for the virus, for COVID, or more stimulus. of the central banks, right? So you don't want to load the boat. I want to be more conservative in this environment. What I have done in my own trading is I'm focused on taking a larger number of small positions. That way I can spread my risk into many different areas. I have found that to be a much better approach. So using the 27 puts, ideally, I'm looking for a delta between 0.6 and 0.65. This 27 put has a delta of minus 0.72, a little bit higher than I normally see, but it does get me slightly in the money. It does have plenty of open interest, 3,600 contracts of open interest. The higher the open interest, the easier it's going to be to get in and out of trades at good pricing. Right now, those options, pretty tight markets here. There's a 3-cent difference between the bid and ask prices. That's a pretty tight market, should be able to get filled almost immediately on this trade. And right now they're trading, these put options are trading for right around $2. $200 per contract gives you a bearish bet on Bank of America. The $200 is the maximum risk on the trade, the most you can lose. So limited risk, big reward potential. If I get into this trade for $2, my initial target is $4. I'm looking to double my money on the long put position. Right. So if I were to take a look at my portfolio, I get this question quite a bit. What is my split between just buying calls and puts and using vertical spreads? Long term in my own trading, I am typically, I would say 70 to 75% vertical spreads. Okay. And 25 to 30% long calls, long puts, just depending on market conditions. I prefer the vertical spreads because they give me a higher probability of trade, and they also allow me to control my risk better than just buying the outright calls and puts. The outright calls and puts give me the bigger profit potential. You just need more to go right. You need more to work out in your favor. So a mix of those approaches is going to be ideal. As far as what is my current portfolio, what does it look like as far as positioning? I'm definitely leaning bearish here. I do have some long exposure on with a handful of names, just again, not knowing what the market's going to do. I want to have some bullish and bearish positions on. I'm not always going to be 50-50 split there. I'm not always going to be delta neutral, right? I'm going to have more of a directional outlook. And right now, my directional outlook definitely favors the downside going into next week. So we'll wait and see what happens there. Next week, we'll take a closer look, potentially looking at using some weekly options. But as I mentioned earlier, I am almost exclusively using the monthly options at the current moment. All right. So again, let's go back over before we wrap up. You can see that while we've been speaking the last 30, 40 minutes, notice how that 50-period moving average, we are breaking below it. Definitely important to see here. If that level breaks, it could be a swift move lower down towards our next series of moving averages down around the 325 to 322.5 range. That would be our next area of support to watch. So this afternoon, very, very important, very, very important tell going into next week. And we've also seen the VIX pop up a little bit. We talked about how the VIX was lower earlier. VIX starting to come to life a little bit, still down on the session. So I wouldn't be surprised if we do get a late day bounce at some point, but we'll see what happens. I do expect it to be a very active week next week. Again, as we get closer to the elections, definitely expect this to be a really good time to stay active. So if you have any questions on anything that we've covered today, let me know. Next week, we'll be back. We'll do another one of these sessions next week. Hopefully, I'll be able to show some additional TradeStation charts. That would be nice. So I apologize for not being able to show you those here today. But if you have any questions here, feel free to post them into the chat before we wrap up, or you can contact me directly. Mike@netpicks.com is my email address. Would love to help out with any questions you might have. So again, really appreciate everybody joining us here today. Enjoy your weekend, everybody. I'm going to start to wrap up. We will be doing another session next week. We'll send you out an email letting you know when we have the details scheduled. So we'll talk to you guys then. Enjoy your weekend, and we'll talk to you next week.